Morning, and there's my friend, Mr. Pargamonic. How you doing, D?
Hey, Will, how's it going?
Good. You want to start with the disclaimer right away?
Yep. So good morning, everyone. Before we get started, keep in mind, Will and I, Market Chameleon, we're not registered investment advisors. We're not broker dealers. We're not telling you what to do. We're just sharing ideas. If you need professional help, call your broker. That's what they're there for, to help answer your questions and provide you with guidance. There's the disclaimer.
So what do we got cooking for this morning, my friend?
So I think, I've been getting some emails with questions. Some of them I see Jake has emailed me, and the question was about stock contingent option. So he's seen some option trades with stock contingent. I think then what I'll do is just go over an example what that means. So if you're using the option block trade screener to kind of find ideas, see what's going on in the marketplace, and you see different types of trade conditions, that could signal something different to you. So we'll go over an example of an option trade that is stock contingent. Okay. Cool. And anything else, along the way, if you have any questions, just let me know. If you guys have questions, you can put them into the chat, or you're still putting out the link. Yep. Click on the Zoom link. It'll take you over to Zoom. You can raise your hand. Then you could actually ask the question directly, so we could hear you. You don't need to turn on your video, but once you turn on the sound, we'll all be able to hear the question. With that, we did the disclosure already?
Yep.
Okay. So with that, we'll just take a quick peek what's moving in the pre-market hours. And then after that, I'll go to that option block trade screener. So these are stocks that are trading in the pre-market hours. We have the most active stocks, biggest percentage gainers, biggest percentage decliners. I'm seeing here on the list, 110 stocks made our percentage gainers list, 34 stocks on our percentage decliners list. So from that perspective, it looks like a more bullish bias at the open. Let's take a quick look at the higher market cap stocks, see if we see a similar situation there. So I'm going to use this market cap filter up top. Let's take a look at stocks 20 billion market cap or higher. So here I see 27 made our percentage gainers list, 5 on the percentage decliners list. So right now, it looks more like a bullish bias at the open, but these lists, they're not huge. We don't have hundreds of them. So I would say mixed to bullish bias at the open. If no questions are popping up now, I'm going to go to that option block trade screener.
Yep.
Block trades over here. And it's a popular screener. People use these filters and look at the option block trades to find trade ideas, see how things are trading in the market. If there's any clues on, certain types of patterns or unusual behavior that if you watch it every day and study how how order flows moving around, you spot things unusual. So these are people who really study order flow, look at order flow, find things that they think are unusual, where people are building up positions somewhere or having unusual position buildup. So one thing is, I think that people who start out think that you just look at large volume trade or big volume trade and just piggyback right away. And that's not how it works. Really, you're using this to monitor things, generate ideas, and see how things played out to learn along the way. So, when people use this, it's kind of, if you think of it like if you're playing chess, a lot of people watch how other people play chess to see how things play out. If you see coaches for a football team, they're gonna watch videos of historical games of their opponents or historical games to see how the strategies and how things worked out and what worked, what didn't work. And that's really the idea, and I know some of you are very good at it, some and some are getting better, and there are other people, and I always emphasize, don't look who are looking for quick and easy things that they think like right away, they're just going to piggyback on a big trade. That's not how it works. There are big trades in the market. The stock market, the options market's the most liquid market in the world in the US. It can handle very big trades. So just because there's a big trade one way or the other doesn't necessarily mean anything. The idea is to watch how things progress and play out so you get better along the way. Okay, so you're kind of learning as you go. So that hopefully makes sense to people, because a lot of people I hear very trigger happy. People who first start out are trigger happy and they're going straight to execution without trying to figure out what's going on. So having said that, what I'm going to show is that these are large option block trades that are happening throughout the day. So you could see there's a lot of them, 221,000 trades that made this screener alone. Okay, so what it's looking for is option trades that are at least 10,000 worth more than $10,000 in notional value. So it's taking out all the smaller trades that are perhaps smaller notional trades, $100, $200, $300, just kind of focusing on the larger ones. And you could really use these filters, to go up higher and higher. Starts out at 10,000, goes higher. And not all trades are the same, right? Option trades could be, they could be a single trade, as simple as, buying or selling a call or buying or selling a put, but they could also be spreads where you're doing call spreads, put spreads, butterflies, iron condors. So you could enter in trades like that. And then there's a trade that came up is contingent. Okay, so it's stock contingent. Basically, if to execute the trade, you have to have both the leg of the option and the leg of the stock execute simultaneously. So you're not legging into anything. You want the entire trade executed at one price, but you want to make sure you have both, because if you're legging into something and you put out, let's say you're trying to do a buy rate and you put out a call. Well, if you sell the call and the stock is running and you're buying the stock at a higher price, well, then you just did it at an inferior price, right? You kind of like left yourself out there to get run over. So to make sure you get both sides, you could enter in a trade that's contingent, right? And getting out of a buy rate, same thing. Because if you leg into it, and if you're trying to do one side, and then you say, once I get executed on the other side, then I'm going to do the other side myself. Well, you're just exposing yourself to adverse selection, right? So market moves adversely against you, and you lost. So you're really taking on a different risk when you're doing that. So that's what the idea is, that you don't need to leg into things. The exchanges and your broker should be able to allow you to enter in an order that you get executed on all sides of your trades simultaneously at the price that you designate. So having said that, let's look at, these are all these different trades, and here's the condition, right? So over here, condition, this is multi-leg auto execution, and we're going to look at trade stock contingent trade condition right here. So now what I did was all these options trades in this table, by selecting stock contingent, I'm only looking at options trades that had a stock contingent condition. Okay. And just to make it, I know like a lot of times the ETFs trade that way. So what I'm going to do is just look at common stock. It'll just be a little bit easier. So I'm going to do stock type common. So right now I have common stock with stock contingent. And let's look at a higher notional trade. So I'm going to use this trade notional. Okay. And I'm going to filter by highest. So this is a $20.1 million options trade in SQ at 1205.58. Okay. It has a stock contingent condition on it, trade condition. And let's just, before we get into that, looking for this, let's just see what else happened here. So in SQ, we see that the January 19th, 2024, so right away, it's a long dated option, right? This isn't something that's expiring in a month, 2 months, 3 months. This is pretty far out there. It was the put, the 290 strike. The stock reference price was $243.81 at the time that this option traded. There's no open interest in the morning. So this is not a closing trade because there's nothing to close, right? So this had to be a new opening trade, 2,300 contracts here for $87.20. So you see that it's an in-money put spread, right? 290 versus 243.81. This was a new position being established, $87.20. Here was the bid and offer at the time, 85.85 on the bid, 88.95 on the offer. This traded like in between that spread, 87.20. So this was basically a negotiated spread, right? They're trying to, yeah.
We have Jake has popped in and says he's glad to come on and ask his question if you want to talk to him as well.
Yeah, I mean, I think maybe Jake, if I finish this example, it might be just not to cut it off. But then
D, you may want to shift your mic around. You've become an underwater creature.
What I'm going to do is, finish this example, and then after this example, I'll take Jake's question, just not to, cut in the middle of it.
All right, awesome.
So this is what I'm seeing right now. The market, was the trade itself traded in between the bid and offer at the time. Okay, so here it was kind of like somebody met them in the middle. It was a big trade and it had a stock contingency. So what I'm going to do is look for the other side of this stock to try to figure out what happened. And keep in mind, I have no idea, and nobody knows the idea if there's another position that whatever this person's doing, we have no idea if they have other positions in place, if these are hedges, or we have no idea. We're just taking this single trade on its own and trying to figure out what this trade is and what side, if I had to participate, or if I had to choose, which side would I choose, and is it a good risk reward? That's all we're doing. And we're kind of learning, because then in our mind, well, what happens to this afterwards if I see this again? What's going on in the marketplace? Do I see this in similar stocks, whatever? But again, all you're doing right now is just kind of paying attention and trying to learn what's happening in the marketplace. Just like a coach, what's the coach's job? He's going to watch videos of how other teams played. What kind of plays did they have? What did they try to do in different situations? Just like a boxer would watch how other people box videos to get clues and ideas how, what are the things that other people do that work. That's the idea behind this, okay? You're trying to learn. So now we know what this trade was. I'm going to take a look at if I could find that stock, right? So here's what I'm thinking here. There's 2,300 options, right, that traded. So are there, and I see that the delta of this option is 50. So if he did it one for one, right, I should be able to find at this time, around 1205.58, assuming they put it up at the same time, about 2.3 million shares if he did it one for one, or about half of that if he did it delta neutral, okay? So up here, this is the stock contingent trade screener. So I already have it, not to leave this, I have it up here, stock contingent trade screener. So these are all the stock trades that were marked contingent. So let's look for SQ. Now I'm filtering out all the SQ stock contingent trades. And what was the time I said it? So this options trade happened around 1205.58. So I'm going to go here are the timestamps of these stock contingent trades. So I'm going to go down here. So it's not on the first. So 1205.58 right here, right? I see 23,000 shares. Sorry, I said 2.3, 23,000 shares, right? Which is 2,300 of the which matches up with this 2,300 options, right? 23,000 shares at $244, right? So $244. It traded at that time. The market was 243.81, 244. So it looks like they did it kind of on the offer of the ask. So now we know, right? Now we know kind of what transpired, right? So actually that would have been, so he only did 10, by my math, he only did 10% of it, right? So this is what happened. 23,000 shares versus 2,300. The stock contingent was that he only did 10% of the shares that he needed, right? 10%. Is my math correct? Otherwise, it would be 200. He could have done up to 230,000. He did 23,000. Okay, so he hedged at 10 delta. So it was more, you know, and he could have had a different delta on. So we don't really know what he had on there. Okay, but this is what we're seeing here. So I'm just gonna take a look at here. I'm gonna go to this option myself, right? So January 24th, I'm gonna click on it and see, well, what do I think happened here, right? So here we see, this is it, the 290 put, 2,300 traded, right? I could open it up and I see there's the trade, 2,300, 87.20. This was the market here. And I see here that the implied volatility traded at 39.3. So that's the implied volatility reference. And it's kind of still in between here. You know, so the implied volatility yesterday didn't really go up in this, you know, in this particular option. And so my first thought is, okay, was it is hedged. Was he doing a volatility? Was he just taking an option that he thinks is relatively cheap and buying the implied volatility, thinking that the implied volatility could increase, and in the meantime he could hedge the deltas, you know, maybe he and traded back and forth. So where's the historical stock volatility here? So I see it traded at around, what did I say was 39. So I'm going to look at the stock volatility here. And I see in the last 52 weeks, the stock traded at a realized volatility of 51, 20 days 39.7. So it's been coming in, yesterday 70.1. So if I think that this is going to revert to a 51 volatility and I'm trading it at a 39, then I'm getting a deep discount, right? I'm getting a pretty good discount of the implied volatility versus the realized, right? So the realized volatility, I'm assuming, is going to be higher than the implied volatility I'm buying. Usually it's in reverse. This time I might be getting it at a cheaper discount, right? So that could be one thing that the person could be looking at, not necessarily, but I'm just looking at how things are spreading around the board. I could possibly, there's a lot of trades here. I could maybe go in there, create a time spread where I could sell a volatility in a nearer term. That's possibly, maybe he already had that on. We don't know. But these are things that you start thinking about, you know, what was his thinking? You know, what would I do and how does this play out? Maybe I should watch this, come back to SQ, see if there's similar situations in other stocks and how does this play out, right? That's kind of the idea. And you could see here, 584 trading days left. So there's a long time for these things to work out. If you hedge it 1 for 1, let's assume he hedged it 1 for 1, right? So this is what a put looks like, right? So the put here, you start making it on the way down. Basically, when you buy a put, it's a bearish bet if you do nothing else. But let's say instead of not just buying the put, you bought the stock 1-for-1. You bought one put and bought 100 shares of stock. Well, this will reverse. This will look now like a synthetic call. So I'm going to do load strategy. And now you see that now it's flipped. Now you're making on the upside, losing to the downside. What if you did it delta neutral instead of 1-for-1, instead of doing one put, 100 shares of stock, you do 50 shares of stock, right? Let's see how that looks. Now it looks like, here, it's gonna look like a straddle, right? You're gonna make it to the downside if it goes far enough, or to the upside if it goes far enough. So again, it's how you hedge it your risk profile is going to change. So it depends how you hedge it with the stock. Okay. So Will, you said Jake Sinner wants to ask a question. I'll take the question, but just wanted to show that real quick. Will, you're on mute, so I can't hear you.
That was great, D. Sorry about that. Let me pull Jake over. We did have a question too from a new chameleon on the chat asking about the contingent stock screener. I don't think we have a contingent stock screener, do we?
Well, this is what I just showed. This is this contingent stock screener.
All right. Well, how do you get to that? I guess is what he's
asking.
So
when you're under, so I'm on option block trades. When you click on it, you come to the option block trade, and there's 4 tabs. 1, 2, 3, 4. It's the 4th one, contingent stock trade screener. But you could also, if you're, so this has all the contingent. I mean, if you're just looking for contingent trades, yeah, this is the best way. Just, you have these tabs over here. Just go to that last tab.
Well, there you go. Hopefully that helps. All right, Jake, you're coming on. You ready? Here we go. Here comes Sir Jake Kilby. Welcome, Jake.
Hey, Jake, how's it going?
How you going? You well?
Yep, we can hear you. Yep.
Cool.
You're good.
Yeah, this is really cool. I really enjoyed, the last couple of shows have been really good, and I really enjoyed them. And you got me thinking, I think a day back, was it IYR you did a screen on, and you saw things like $4 million worth of, I think it was on the put side. Remember you? And it was I think it was a spread of some sort.
Yep.
The question I've got, right, so we're looking at that, and it was like, okay, we think that this person or this trader, institution or whatever may have done a bear put spread on IYR. And I was thinking about it, and I was thinking, well, if you've got $4 million, why would you do it on the put side with a debit and not do it on the call side with a credit, all things equal, right? Because rather than commit your capital, why not take on that credit, particularly with $4 million over, I think it was like 2 weeks or 3 weeks. What I'm trying to get at is, how would we even know whether it's a bear put spread or a bull put spread? See what I'm saying?
So the way I'm understanding your question is, why would he do a put spread instead of like a call spread? You mean?
Yeah. So if he's bearish, you've got a bear put spread, which is a debit, right? Or you've got a bear call spread, which is a credit. You've got $4 million. Why would you immobilize $4 million of your cash when you could potentially do it on the call side?
So the question, Jake's, let me try to set this up. Okay. When I think the question that Jake is asking, why would you do a debit spread, right? Like if I bought this put and sold this put, right? I bought the 104 put, sold the 102 put, I'm net debit, right? So I'm paying, let's say 89 cents, right? So instead of paying 89 cents, why don't I sell the call? And instead of doing that, why don't I sell this call at 102 and buy this call at 104? and collect $1.13. Is that your question?
Yeah, more or less. Yeah, simplistically. Yeah, correct.
Okay. So when you a debit put spread or credit call spread on the same lines should have the same risk profile. Okay. Otherwise,
Correct.
there's an arbitrage. So
Correct.
the risk profile should be the same. If it's not, then there's an arbitrage opportunity. Now, sometimes you might get a little bit better because of the spread, but they shouldn't be skewed. They shouldn't be crossing each other. So your risk profile should be the same. In other words, you're risking the same amount to make the same amount. Okay. They're just mirror images of each other. So your question is then, well, why, if those are the circumstances, why don't I sell it instead of buying it? Because I could receive money instead of paying money. Is that correct?
Yeah, that's correct. And it was a big trade, right? This was a couple of $1 million trade.
Right.
Why immobilize $2 or $3 million when I could not immobilize and do it on a credit?
Okay. So the way for your questions, first of all, as far as interest rates go and everything, that's also priced in. Okay. But when you think about a debit spread or credit spread, as far as immobilizing to a portfolio margin or professional account, you're not immobilizing anything because what you're using is a risk-based haircut, meaning that it doesn't matter if you're paying or receiving money, your haircut is based on the risk. So if your risk profile is the same, it won't matter. If you're debit or credit, the haircut, the money that you're immobilizing is based on risk-based haircut, right? So you could read about it, risk-based haircut. That's how clearing firms, a portfolio margin, a professional account, market making account, it's based on a risk-based haircut. So RBH, you ever hear that?
I haven't heard that one before, no.
So for him, it wouldn't make a difference as far as immobilizing money. That's not how it is. Maybe a little bit, it could make a little bit of a difference if he's receiving interest on, more interest on the money inside the account, but I doubt it. Or he's paying. So it wouldn't really matter from that perspective. One benefit of doing a put spread instead of a call spread is if there's a dividend, you might have that broken up. And if you want to hold it to expiration and there's a dividend in between, you don't have that part of the risk, right? So if you have a deep in the money call, stock goes up, they pay dividend, you get called, then you have to exercise your call, you'll get it taken away. On a put spread, there's no exercise for dividend, right? Maybe for cost of carry, but not a dividend. But as far as, it wouldn't make a difference. So he's not immobilizing $4 million because what he's doing is just based on that risk profile. Whatever the clearing firm, once they run that formula, that's how much capital he has to allocate to that trade. So it would be the same. As long as the risk profile looks like the same, that's how much he's immobilizing. Okay. So think of it like a risk. So portfolio margin account, let's just say you get a 6-to-1, leverage, right? Yeah. So you get 6-to-1 leverage. So you buy stock, right? If you buy stock, you put up $1 for every, $6 worth of stock, risk-based haircut, right? If you short it, they're going to calculate the risk, and you're going to immobilize whatever, they figure the volatility or whatever that you short, but it's based on the risk of the position, not the cost of it. Okay. So that's how it would be done. So you could look it up, risk-based haircut. I don't want to do it right now because it's 9:30, but you guys could look that up.
Okay, thanks very much. Much appreciated.
Yep. Thanks, Jake. It's a good question, because I think a lot of people also I think the problem is that people automatically assume with spreads that if I'm selling a put spread or credit or a call spread, they're assuming that they're automatically getting short vega, short volatility, short implied volatility. And that's not the case. That's not how a vertical spread works, because it depends where the stock is relative to your strikes. So like I had, for example, I had one customer really quickly was super, wanted to sell deep into money put spreads. And he's like, well, I want to sell deep into money put spreads because that's whatever he thinks that's the best way to short vega, right? Like volatility when implied vol is high. That's absolutely wrong. It's like the opposite, but I don't think he really he just wrote an email that I'm going to find, these elsewhere, but go put in a deep into money put spread, and we could do it really quickly, right? Here's a deep into money put spread. Like I'm going to go out here. Let's see where there's lots of strikes. Here's a deep into money put spread in iWire. I'm selling this, right? And buying this deep into money, right? So I'm going to get a huge credit right now. Here's my credit, $14. So I got $14 credit. So the deep into money put spread, but look what my vega position is, 21. So if you positive 21, right? And my theta is negative. Every day, nothing happens, my theta is going to eat away. And every day implied volatility comes in, you're going to lose money. So even though you got a credit, you're going to be losing money every day on this position. So you're actually doing the opposite of what you're thinking you're doing. And people, they'll figure it out, but the lesson will be learned through, because he's not paying attention and trying to learn, the lesson will be learned, the hard way, which is okay, because sometimes that's how we have to learn.
Sure.
Yeah. Awesome
Thanks,
job.
much appreciated. Really enjoyed it.
Great job, Jake. Thanks for coming on, my friend.
All right. Thanks, Jake. Thanks everyone for joining.
Hey, D, before we go, we have a brand new chameleon on. He's asking where we can see this video. Could you just show him where it posts on the site on the
so the daily videos, we just there's it says videos up here on the main menu. If you click on it, we post the daily videos. So this would be today's, and you could go back, to see the previous ones in here. So just click on it and you can watch them in here. But this would be today's. The top one is today's. Or the most recent.
Awesome job, Dima. Thanks so much. Have a great trading day, everybody.
Thanks, everyone. Have a good trading day. Stay safe out there. Hope to see you guys tomorrow.